Hello. We are having our drop-in review session for today, and we're starting with the Chapter 9 problem. So we'll be going through this problem. We'll do most of it together. There may be some parts that I suggest you can complete on your own, but just as a warning, the numbers in my problem may not match with the numbers that you have in the problem in front of you. So although the approaches, the calculations will be the same, you'll just want to make sure that you're using the numbers that are actually in your problem, which may not match up with what's on the screen right now. So looking at the problem, we're starting with depreciation, and Patterson Planning Company has had a fire, so some of their records were damaged. But what we do have is this depreciation schedule, and we have 3 different assets and 3 different versions of depreciation. One of them, it tells us the depreciation rate is $4.30 per hour. And so we know when they are recording depreciation based on hours, rather than the passage of calendar time, that would be a production method or units of activity method of calculating depreciation. The other 2 then are going to be based on either straight line or double declining balance, the accelerated method. So let's go to our first question, where we're asked which one of these schedules would make sense based on this asset description. So an asset producing steady revenues, we may want to use the straight line method, where we record the same depreciation every year so that we're getting a good match between the revenues being generated and the cost of that equipment or whatever the asset is. And so as we look at these 3 columns, there is one of them that is recording, for the most part, is recording the same depreciation each year. And that is Schedule B, where in year 2, 3, and 4, we recorded exactly the same amount. And what you'll notice, if you look at years 1 and 4, if we were to combine those together, then it would be that same $13,500. So why would that happen? Based on what we did in class, you should recognize that it appears that in the first year, we didn't have the asset for the full year. So we recorded a partial year depreciation in year 1. This asset must have had a total useful life of 4 years. And so the rollover part of that depreciation was then recorded in year 5. So 3 full years and 2 partial years, making 4 total years using straight line. So that would be appropriate for an asset that's producing steady revenues. Stop me if you have questions. If you don't have questions, if everybody's good, then you don't need to say anything, but definitely if you have a question as we're going through this, please make sure you ask. You can either unmute and ask the question, or you can post it in the chat, whichever is more comfortable for you. The second asset description is asset with variable in-service time. And so that would make sense to use that approach when we're using the units of activity method, depreciation rate based on the number of hours that asset is being used. And so that seems to match up best with Schedule C, where you can see we have 9,000, 6,400, 7,300. It kind of bounces around from year to year. There's no steady detectable pattern. And so that would go with Schedule C. And then by default, we know that this one would have to be A, but let's read it anyway. Asset generating greater revenues in the earlier years. For that, we would want to go with an accelerated method, such as double declining balance, where we front load that depreciation, we write off the expense more in the earlier years. And by the time we get to year 5, we have a much, much lower rate of depreciation. For question 2, I want to draw to your attention this line, because when I've used this problem in a previous semester, this part seemed to give people difficulty because we're just accustomed to, if there's a box there, we should put something in there. But the directions specifically say, if an amount box does not require an entry, leave it blank. And really what they should have said there was, or if it can't be calculated with the information we have. And that will be true for some of this information. There's no way for us to be able to determine what that value should be. So let's start with asset A. And asset A, we said, is using the double declining balance method. And it appears that the asset has a useful life of 5 years. So what I'm going to do, I can get my annotate function up here, is remind everyone of the formula that we use for double declining balance. And remember, these formulas are in the reference materials folder for chapter 9 in Blackboard. So you can find them there, but I'm just going to put the relevant one here on the screen. So for double declining balance, the formula that I use, it's what I put in Blackboard. Mathematically, it's the same as what's in the book, but I just put it together a little bit differently. So my formula is 2 divided by the useful life times the depreciable, sorry, the carrying value. Okay. So this is the formula that we have for double declining balance. And we're able to identify the useful life. They recorded depreciation over 5 years. We know the depreciation for year 1. And so I'm just going to plug that in. And I'm going to label this double declining balance depreciation. So we know the depreciation for year 1 is $12,000. We know that the useful life, we can see that they depreciated it over 5 years. And so the useful life would be 5 years, but we don't know the original cost. For double declining balance in the first year, when we haven't reported any depreciation yet, the carrying value is equivalent to the historical cost. So since this is year 1, I can make that substitution. And so now it's just a matter of solving for that historical cost. Since it's 2/5 times historical cost, to get rid of that, to get historical cost by itself, I'm going to multiply each side by 5/2. So 12,000 times 5/2 equals the historical cost. Go ahead and solve for that. Was everyone able to get 30,000 for that?
Yes.
Okay. Let me scroll down and we can enter that. So we're working on Schedule A. The asset cost would be $30,000. Okay. We already identified the useful life as being 5 years. So let's look at the residual value. How much depreciation did we report in those 5 years that we used the asset? It's right here. So if it cost us $30,000 up front, and then over its useful life, we reported $27,000 in depreciation, what must be the residual value? It's the part that's left. It's the part we haven't depreciated. And so 30,000 as the original cost minus the 27,000 that we depreciated gives us the remaining or residual or salvage or scrap value, trade-in value. It's what's left of that asset on our books. For total operating hours, we don't use that calculation, total operating hours, when we're using double declining balance. And so that's one of those, that's the first box that we cannot answer. We can't calculate total operating hours. We don't know if this was used every day or once every third month. So we can't answer that question with the information we have. So we're just going to leave that blank. Everybody okay with that column then, the using double declining balance? Just want to say that I know this problem, as many of our problems, it's a challenge because they ask us to think about things not necessarily in the way that they would happen in the normal course of business. So this is clearly a very unique situation that they're telling us we don't have all the records. And so we're trying to recreate those records with what we have. That's not how this would normally work. We would know, here's how much we paid for the asset. We would estimate, here's how much it will be worth. Here's how long we're going to use it. And we would go really from front to back. They're asking us, we're now on the back end and we're trying to recreate that front end information. And I think that's why it makes this challenging. It's also why I like these problems, because they do make you really think about, what do we know? What are we trying to find out? How does what we know fit into what we, to the formulas that we know how to use? But I recognize that makes it more difficult. And honestly, that's why I'm very happy to have these kind of review sessions or meet separately, individually with people to go through these, because I think it's an important concept. Okay, so if no one has questions about that one, let's move on to column B. And column B is the straight line method. So we can see that the useful life, we already talked about this, was 3 full years, and then year 1 and year 5 combined to make the equivalent of another full year. And so the useful life for column B's asset would be 4 years. Are we able to find the residual value? Well, we know how much depreciation was recorded, but the formula for calculating depreciation under straight line, unlike, just getting my annotate back up here. So for straight line depreciation, the formula starts not with historical cost as it did for the double declining balance, but it starts with the depreciable cost. And then we divide that by the estimated useful life. And I know I'm being inconsistent with my using capitals and not using them. I don't know why I'm doing it that way. So we know how much the depreciation is each year. And because we know the useful life, we could then find the depreciable cost, which would be $54,000. There's no way for us with this information to determine what the residual value is. It doesn't give us any information beyond what's in this column. So there is no way for us to determine the residual value. So we have to leave that blank. There is no way for us to determine the asset cost because we don't know that residual value. So again, we're going to leave that blank. And then finally, the total operating hours is not a relevant statistic. It's not a relevant piece of information when we use the straight line method. And so really the only thing we can calculate from the information that's given for asset B is the useful life. And all the rest of those, we just need to leave those blank. Questions on that? Okay. So for Schedule C then, this is the one that we said is using the production method or the units of activity method. And we are told what the depreciation rate is, $4.30 per hour. So if we can see the total depreciation here of $45,150, we can then back into how many hours the asset must have been used. And so I'll put on the screen the formula that we had for the units of production method. So to find that I don't know what to call it, units of production depreciation, just going to abbreviate. And so to find that units of production depreciation, we take the depreciable cost and we divide by the estimated useful life in units. And then we multiply by the actual units used. We can see in that table that the total depreciation that I have highlighted right now was $45,150. And we know that the cost per unit is $4.30. That's given in the problem, $4.30 per unit. That's this part of the calculation. Depreciable cost divided by estimated useful life. Whoops, left a word out there, didn't I? Useful life in units. And so we now have an equation that will allow us to solve for actual units by dividing both sides by $4.30 per unit. So the total depreciation, $45,150 divided by $4.30 is 10,500 actual units. Again, it's the same formula that we learned in class for calculating units of activity or units of production depreciation, but the missing piece isn't the dollar amount of depreciation, it's the units in this case. So back down to our table, the useful life is actually the same as the total operating hours. So when we use a production or activity method of calculating depreciation, we don't measure the useful life in months or years. Instead, we measure it in units of activity, which in this case happens to be operating hours. But just like for column B, the straight line depreciation, we have no way of being able to calculate the residual value or the asset cost because that information is not provided to us. So again, I think that if you worked on this problem and struggled with this part, it may be that the reason you struggled is because the problem itself is unclear. It does not specifically say some of these pieces may not be able to be calculated and then leave them blank. So when it says the amount box doesn't require an entry, that's really a little misleading. We're not saying that asset B and asset C did not have a residual value. We're certainly not saying it didn't have an original or historical cost. All we're saying is we can't calculate that. And so don't feel too badly if you were stuck on that part, not knowing how to calculate those because we can't calculate them. Does that make sense? As I said, if you don't have questions, it's okay to not say anything. So let's go on to the final questions then. Review the depreciation schedules and then answer the following questions. How would you adjust Schedule B if at the beginning of year 3, the asset was estimated to have 5 more years of life remaining? So that means 2 years have already passed and then they decide that it's going to last for 7 years. And we had said asset B actually had an original useful life, we thought, of 4 years. So we're now going to allocate the depreciation over 7 years instead of 4. But the residual value was $1,500 higher. So if the residual value is $1,500 higher, and that means the depreciable cost would be $1,500 lower. So as we look at Schedule B, the original depreciation was, as you can see where I highlighted, $54,000. But if we increase the residual value by $1,500, the depreciable cost will go down to $52,500. So the total depreciation, to answer the first box here, the total depreciation on this asset will now be $52,500. The depreciation amount for year 3 will be, okay, so in year 1 and 2, we didn't have this information. So in year 1, we had already recorded $10,125 of depreciation. In year 2, we then recorded another $13,500. So I should probably write this on the screen. And so we started with $52,500 that we were going to record in total depreciation for this asset. In the first 2 years before we learned this information, we recorded $10,125 and $13,500. So the remaining depreciation on this asset, $10,125 and $13,500. The remaining depreciation is $28,875. And at the beginning of year 3, scroll back down there. At the beginning of year 3, the asset was estimated to have 5 more years remaining. And so that $28,875 that we just calculated is going to be spread out. This is the straight line column. So going to be spread out in a straight line fashion over 5 years. So the depreciation for year 3 would be $5,775. We first calculated the remaining depreciation after the first 2 years. When we learn this new information, we have to revise the remaining year depreciation, and we take that remaining depreciation, divide it by the remaining 5 years, the new estimate of 5 more years of life. Make sense? Okay. So let me clear that stuff off my screen because I don't think we're going to need that anymore. And let's scroll down so we can see the rest of the questions without having all of that writing on the screen. What is the difference between the journal entries for discarding or selling a fixed asset? Okay. The journal entry to blank differs from the other entry because, and these are our options. A sale will involve a gain, disposal will involve a loss, the book value will not be 0, the asset will be fully depreciated, there is no receipt of cash. So the only one we know for sure is that if we discard the asset, there's no receipt of cash. A sale might involve a gain, but it might involve a loss. It depends on how the cash we realize compares to the book value. We did an exercise like that in class. Disposal might involve a loss, but it might not, because the asset, when it's discarded, could have a 0 book value or 0 carrying value. And so there would be no loss involved with that. The book value will not be 0. Well, we can't know that. it could have a zero value whether we sell it or dispose of it. So that one may not be true. The asset will be fully depreciated. Again, we don't know that. It could be that it's fully depreciated, but it could be that we sell it or throw it away partway through its expected useful life. And so the only one we know for sure is true in one of those situations is when we dispose of an asset, when we discard a fixed asset, there is no receipt of cash. And so that's the only combination that works. Finally, complete the following sentences about depreciation. When a fixed asset is fully depreciated, it is blank if blank. Okay, so we have to find two of these. I wish I could have both of them open at the same time. So if it has a residual value, and I'm just reading through the options here to find two that match up. It is, so just to define fully depreciated, what that means is we have depreciated 100% of the original or historical cost. So if the asset cost us $10,000 up front, we have recorded $10,000 worth of depreciation. And that means that it has a book value of 0. It could be discarded, but we could keep using it. It could be sold, but we could keep using it. We would not remove it from the accounts as long as we still have that asset. It should still be in our accounts, and it would be kept in the ledger if we were still using it. So that one would match up. The asset, if it's fully depreciated, it is kept in the ledger if it has not been removed from service. That part is true. Okay. We would remove it from the ledger only if we sold it or got rid of it, threw it away. The balance of the accumulated depreciation account represents looking at those options. The only one that is correct is the accumulated depreciation is the total amount that has been depreciated or recorded as expense. Depreciation measures the transfer of cost of a fixed asset to expense. The other things that are choices here are not true. It is probably true that a fixed asset gradually loses market value over time, but that's not always true. Think about an antique car. So an antique car is worth more now than it was originally. And so that doesn't mean that you wouldn't depreciate that. Doesn't necessarily reflect a decrease in market value. The amount of wear and tear on a fixed asset during its useful life. Again, that's partly reflected in the loss of value, but that's not the reason we do depreciation. The expected service life. Well, depreciation is not the expected service life. It's calculated using the expected service life. And so, again, that last one is the only one that is always going to be correct. Depreciation measures the recording of the upfront cost, spreading it out over the useful life of that asset. The reason we do that is because of the matching principle. And so we are done with that exercise, or that, excuse me, that problem. And so what you'll notice is with these boxes, it doesn't give us the red X's. If we had put a number in there that was incorrect, it would give you a red X. If we had left another one of these boxes blank like that, it shows that we didn't achieve the full 100% score, but it doesn't tell us where our error is. And so again, I think that contributes to why this problem is a little bit more challenging than maybe our other problems have been. Just pause the recording for a moment.